Hey there. As an HR professional, I had the unpleasant task of informing folks their jobs had ended. The majority of people I laid off were great performers. They did their best and they were just genuinely good humans. It was really tough to see strong people break down in my office. For most Americans, getting laid off means zero income starting the next morning. But what if during your employment you leveraged your money? Robert Kiyosaki once said, "The rich don't work for money, they make their money work for them." So let's look at three types of income. Most people's income is active, which means it's from a consistent paycheck. But wealthy people typically earn residual or passive income or both. Active income is from your employer and requires activity in exchange for money. When you stop, the income stops. Residual income means you receive money after the work is done. For example, every book an author sells provides residual income. And then you have passive income. It's earned with very little effort and continues flowing even when you aren't working. Now, real estate investments are one of the most stable sources of passive income. Now, remember the job loss scenario? So let's pretend you had built passive income on the side during your employment. Since being laid off, your earnings decreased by your monthly salary amount, but you still have income. So financial freedom is achieved when your earned passive income is more than your active income. So historically, the stock market returns about 8% annually, which means $100,000 would produce roughly $8,000 per year. That's about $667 per month. So to replace an income of $3,000 a month, you'd need $36,000 per year, which is about 8% of $450,000. However, with real estate, $100,000 could buy a $400,000 rental home because the bank brings $300,000 to the table. You put in 25%, the bank puts in 75%, and you earn 100% of the profits. So a $400,000 home that rents for $3,600 would net you about $1,500 a month. So theoretically, two investments of this size could replace a $3,000 monthly income. The total rental income plus $25,000 in additional equity would equal $43,000 or a 43% return in just 1 year. But what if you don't want to be a landlord? I mean, the numbers look enticing, but perhaps being a landlord does not. Now, I chose the landlord path in the beginning, and while I'm grateful for the experience and learned a lot, I'm so glad I found the passive investing route. Instead of being a landlord, you join a group of investors. So when investing $100,000 in a real estate group investment, you could earn $8,000 per year, which is 8%, very similar to the stock market, right? However, the real opportunity lies in the sale of the asset. Syndications hold the property for about 5 years. And during this time, improvements are made and the land market value typically rises. On the sale, you receive $160,000, which is $60,000 in profit. Add that to the passive income of $8,000 per year that you were getting, that equals $200,000, which is a 20% average annual return. So if, while employed, you're able to create passive income, you'll be less stressed when facing a layoff. And you may even find yourself celebrating unemployment. So thanks for joining. Please like and subscribe. Be sure to grab one of my free guides in the links below. To your success.